Well, this will be episode 2 of Farm to Markets, where we talk about everything from farm to markets. And today we're going to be talking about shareholder resolutions and the fines the SEC has been doling out to big brokerage firms like Robinhood and Charles Schwab. Recently, the Wall Street Journal ran an article about shareholders imposing their views on social issues through stockholder resolutions. Joe, what do you think?
Well, I think we're at that point in our history where the average American has so much wealth that creating more wealth is just not that important to them. And a lot of folks have figured out how to use the shareholder resolution platform to bully large Fortune 500 companies into doing their bidding. A shareholder resolution essentially is an opportunity for people who own shares of a company stock to petition the boards of these companies at the annual meetings to act on certain policies. So environmental issues or governance issues or social justice issues. And even if their proposals are shut down by the board, the CEO ignores those resolutions at their own peril. There was an article in the Wall Street Journal a couple of weeks ago where they did a study and they found that CEO tenure and CEO compensation overwhelmingly is affected by their willingness to deal with some of these shareholder resolutions, much more so than whether or not that CEO led the company to hitting their financial targets. When I first came into business, we didn't have internet. And if you wanted to learn about a company, you got one of their annual reports and they talk about how great they were at making shareholders money. Nowadays, you don't look at annual reports, you look at websites. And if you take a look at websites of Fortune 500 companies, all they're doing is pandering to a lot of these advocates. And quite frankly, it's an interesting place to be because the stock price can be affected not so much by whether or not they're profitable or not, but by whether or not they're ignoring or forwarding a lot of these social justice movements. I'm opposed to it. I think you invest to invest and you do your social activism in a different form.
Alex, what do you think?
Well, I agree with the general idea that you ignore shareholder resolutions at your own peril. But I kind of look at it this way, is particularly progressive investors have figured out that they can generate the social change that they want in society without political power. They can instead use corporate power to do it. Now, whether this is a single big investor or a block of small investors is not really relevant. You only really need 5 to 10% of shares to make a demand before the board or the CEO has to act. I expect there to be a good deal more of this as we go forward for good or ill. And I also expect that more conservative investors are going to, as they see this happening more and more, they will either try and flex their own financial muscles by doing the same thing, or they'll divest from the quote unquote woke companies and reinvest in more conservative companies as competition.
Drew?
So I guess I see shareholder resolutions when it comes to ESG from a couple of different views. One is from a shareholder's perspective. I think shareholders are looking at the wrong end of the telescope. I like to think of it as like I'm flying on an airplane. I don't really care how woke or unwoke the airline pilot is. My biggest concern is whether he can operate the aircraft safely and he can get me to my destination in one piece. I think there's a couple of questions that shareholders need to ask. One of those is compared to what? Because now we have this ESG movement. Before companies...
Hey, Drew, can you explain what ESG is?
Yeah, so that's environmental, social, and governance. That's what it stands for. And they actually, they're weighted, and you can actually get an ESG score depending on how environmentally aware you are or how much you're trying to reduce your carbon footprint, how you treat your employees, those sorts of things. But...
And I'm not kind of actually surprisingly somewhat disagree with you guys, because I think this is actually a pretty good thing for companies, because what you get is you get individuals using free market mechanisms to influence companies and get them to change in the way you want them without using the blunt force of government. because I've seen some other articles where they're trying to get the SEC to start imposing regulations on companies to disclose certain, as you, like Drew said, SEG metrics, so they can start telling how clean a company is, or how, what their social governance standards are and all that kind of stuff. And it costs the companies a lot of money to do that. But if you use their shareholder resolutions and petition the company to make changes without the government, and you let the company decide how they're going to make these changes and signal to the world that they're giving the free market what it wants, that's going to be a lot cheaper and a lot easier for them to come up with ways to do it than having the government come in and make blanket solutions for every major corporation.
I agree with that, but I think you need to ask at what cost. From a humble citizen's perspective, I think shareholders have every right to submit resolutions to companies if they want to see change. They just have to accept the outcomes. And I think if you do that, once you start shifting the focus from profitability and growth to more ESG criteria, you run the risk of scaring off corporate board members, you run the risk of profits going down, and you also run the risk of prices going up to the consumer.
You do.
Well, to Drew's point, that's kind of what's been happening, is that some of these CEOs who haven't moved on environmental, social, or governance issues fast enough have been shown the door, but then they can't find new CEOs who are willing to take over the company at the same compensation that the old guy did, because they're going, hey, this board is already afraid of standing up for what they believe in. They're just pandering to a very, very small but very vocal and very activist group of shareholders. I don't want to work there, and if I do work there, I want to be paid a lot of money to do so.
Yeah, so, but it's better than them. They might as well just petition the company, and then if there's enough support for it, something will change. It's similar to when you see the guy playing a guitar on the street and you give him some money. Usually he doesn't get to pick the song that you play. If he really wants to be successful at playing the guitar on the street, he'll play what everybody wants to hear. And that's kind of what big corporations have to do. Like even if you think oil and gas is here to stay, but the market gets big enough for wind and solar energy, the companies are going to have to switch their revenue.
To add to that point, Tom, with your street busker playing the guitar, either they'll comply or they'll adapt to what the people willing to pay them to play their songs are, or they just won't do it. These are publicly traded companies. They don't have to go public. Once they do, they know that they are held accountable by the shareholders and their demands.
My brief final thought would be on this issue. I don't see it as either negative or positive. It's just investors have figured out they can use these mechanisms to force the change that they want. And whether you're cheering it on or lamenting it, it's not going away. The genie is out of the bottle. And right now it's all the attention is on progressive investors, but sooner rather than later, everybody's going to be doing this. So I don't think it's going anywhere anytime soon. And again, boards and CEOs ignore these resolutions at their own risk.
All right. Well, we'll move on to the next one. Is that continuing with giant corporations, Robinhood and Charles Schwab have both been handed down some historically large fines by the SEC. Robinhood was fined about $70 million last month, and then Charles Schwab just disclosed through one of their quarterly filings that's going to end up paying about $200 million to the SEC, most likely as a result of its robo-advisor platform. Drew, is this a big deal, or is this just growing pains for brokerage firms?
Yes and no. I don't personally see it as a very big deal. We have to remember that these are huge companies. Charles Schwab, if this $200 million fine actually, if they pay it, it ends up being something around 4% of their quarterly revenue. So if you were just an average middle-class American, that's kind of like finding out that you owe the IRS a couple $1,000 bucks. It wouldn't be fun, but it happens, and there's always a reason behind it. So it's not earth-shattering for these companies. Can certainly afford it. But the SEC, they kind of play referee in the whole investment game. So I think it's important for them to hold these big companies accountable for their actions.
Alex, what do you think?
Well, I think it's a big deal. Not so much the dollar amounts, as Drew was saying, these dollar amounts are not huge portions of their income, their revenue, whatever. What's more interesting to me is what's happened to Schwab, why it's fined. Their robo-advisor was advertised as not having any fees. It was that the ETFs themselves had their expenses, and the SEC is fining them for, I think, false advertising on that front, which I think is kind of nitpicky on the SEC standpoint, which to me shows that they're going to hand out big fines for what I think is a relatively minor infraction. On the Robinhood side, I think that was a bigger deal, just because, Robinhood failed at a key moment, and the SEC was not going to let them get away with it. So for smaller platforms, I think they've been put on notice by this, by saying if you fail at a key moment, you're going to pay for it.
Joe, what do you think?
Well, I've been in the business for almost 30 years, and essentially, these fines does two things. One, it frightens small competitors from entering the marketplace. So essentially, it monopolizes the financial services industry to only those large firms that have already become established. So it's going to be much more difficult for a new Robinhood to break into the game when these sorts of fines are played out. The second thing is that the SEC has to justify its existence. So they're constantly looking for opportunities to fine people or to settle with firms for relatively minor infractions. Years ago, I worked for a Fortune 500 company, and we offered these what were known as structured or step-up certificates of deposits. They were paying 2.5% better than bank CDs issued locally. And through fines and settlements, nobody in the brokerage firm provided these wonderful investments that were FDIC insured to the marketplace because people were afraid of getting fined or sued. And the ultimate loser was the individual investor. I think in this case, it'll be the same. The individual investor will have less choices to do business with as a result of these current fines.
And I guess to Drew's point is that $200 million fine to Charles Schwab was only going to make up like 4.2% of its annual revenue or something like that. So it's going to be a drop in the bucket pain. But I think it's also a growing pain for investors, because what they're figuring out is that free isn't always free in the financial industry. Is that when you go to Charles Schwab and they give you free trades, is that all that cash that you have sitting in the account, that's actually what's making them money. And if you go on to Charles Schwab's robo-advisor policy statement, you can read through that, and it says very clearly in those statements how they make their money. And in some cases, they can keep, or I guess in all cases on the robo-advisor platform, they can keep between 6 and 30% of your investable assets in cash. And 30% is a pretty huge number. So I think what investors are figuring out is that, even though you get your free trading, the money's made by these firms somewhere down the line, especially with options trading. And options are horribly complicated. And that's one of those things where you're going to want to read all the disclosure statements that most people just throw away to figure out where you can go wrong. Because when it goes wrong, I mean, it can cost you a lot of money, for some people to the tune of $350,000. So I think, it's definitely growing pains, and it's not a huge deal. But it's definitely a wake-up call to both the brokerages and individual investors that they need to start reading some of the fine print.
Well, I think with going back to Schwab real fast, what's also interesting to me is that the SEC is fining them for having, too big of a cash position in certain investors' accounts.
Right.
That makes me wonder, and I think every investment advisor would have to start wondering, how big of a cash position can you have somebody in before the SEC is going to come in and start fining you? That's a position I don't think really is any business of government regulators to be in, but it seems like that's where they want to start going. So not a big fan of that personally.
Well, it's a huge disadvantage to the robo platform, because when you start keeping 30% in cash, if the market has, if the S&P 500 goes up, 15%, 11%, or it has years where it's in double-digit returns, 15% of 30% of your cash position, all of a sudden you're paying more than you're paying a flat fee financial advisor charging you 1%. all of a sudden we're the discount advisors in the industry if you're going to be keeping that much cash on hand, because the opportunity cost is going to kill you. So this is something that the robo platforms definitely going to have to figure out is, granted, they're just making money off the spread on the loans, but the opportunity cost is getting pretty expensive for investors.
I certainly don't like the big hand of government slapping the little guy, but usually these big fines that are imposed by SEC or FINRA, they're pretty much on par with what damages they did. So to Alex's point, whether they were keeping 30% in cash reserves or 20% or 10% or 5%, I think that would kind of go hand in hand to what the fine is. A lot of these things that big investment firms are selling are extremely complicated. So in that sense, I do like the SEC kind of sitting in the corner of the investor and keeping these big companies held accountable from doing shifty things.
Well, at what point are you responsible as an investor to determine how much cash you want to have in your portfolio? And if you're working with a robo-advisor trying to avoid fees someplace else, and one of the requirements is you keep large amounts of your account filled with cash, you're in a position where you can move to a different brokerage firm if you don't like what's going on. But the idea of the government coming in and slamming these people with these fines, and there really are small infractions. I think we're really splitting hairs about expecting people to read the fine print on this particular issue. But what I have found is that these fines are kind of like poison. And if you're an elephant and you get a thimble full of medicine or a thimble full of poison you have to drink, you might have a stomach ache. But if you're a mouse and you drink the same thimble full of medicine, it essentially is going to kill you. And a lot of these large firms, they're moaning and lamenting and tearing their clothing and throwing ashes on their face over these fines in public. But in private, they're doing the moonwalk because they just wiped out half a dozen competitors who might be doing their job better than they are.
All right. Well, we'll leave that one there. And for the last 30 seconds here, Alex, why don't you tell us, what do you listen? Are you reading anything? Are you listening to anything? Tell us, how does Alex Musso unwind when he's not doing these podcasts?
Well, right now I've been catching up on some of the geopolitics videos on a YouTube channel I really like called Caspian Report. It's just one way of looking at how countries and economies as wholes operate. It can sometimes feel a little bit deterministic, but I think it's an interesting perspective. The other thing I was just listening to the other day was Peter Zion, who's a geopolitics presenter. He's got a new presentation up online from a few weeks ago about the future of globalization and trade in a both post-COVID and an increasingly economically nationalist world. And it was an interesting listen. So I recommend both of those.
Very nice. Joe, what are you listening to?
Right now, I'm listening to a podcast on constitutional law while I'm cutting hay on my tractor.
All right.
Right now, I'm just finished up contract law, and I get these off of Worldrium, which used to be the teaching company.
Yeah.
It's a subscription to college courses on a variety of different subjects.
You like to live life on the edge, obviously, as you're doing that cutting hay. So, but Drew, what are you reading, listening to?
You know what I'm reading. We're starting. Tom and I are beginning the voyage on our next book club book, which is Unexpected Returns, and basically it goes through the concepts of long-term market cycles. Markets are certainly cyclical, but times are also changing. So you can't just necessarily look back on past cycles and think they're going to be projected in the future.
Yeah, if anybody wants to crash that, it's 8:30. It's 8:30 a.m. on Thursdays at the Wild Coffee Company, and you, me, and one other person I can't disclose. And for myself, so is that for me, I'm listening to Nassim Taleb's The Black Swan. Used to be an option trader turned academic, but I think is teaching somewhere in the Middle East. And for podcasts, I always listen to Snacks Financial. The millennial voices on there get a little annoying, but it's always good entertainment. That's it for this one. Make sure you